It doesn't really matter what kind of a method you use for valuing practices. The technical aspects will be different depending on the method, but there's a couple of points that are important no matter which method you use. First of all, no matter how you value a practice, profitability is the basis for the value of the goodwill. And goodwill is the single biggest asset in a successful practice. In a successful practice, goodwill would be 70 to 80% of total asset value, and tangible assets, things like equipment, will only be 20 to 30%. Tangible assets are only important in a practice if they produce profits. So even if the practice owns an ultrasound machine, that only contributes to practice value if it helps drive profitability. So if the ultrasound machine sits in the corner and gathers dust, it doesn't matter that you paid $30,000 for it or $35,000, it's not going to improve your practice value. It's also important to remember that current profits are only important if they're expected to continue into the future. We come back to that concept of the risk factors. So let's say that you are a one doctor practice and you as the owner doctor do some kinds of procedures. Maybe you have a very extensive orthopedic surgery side to your practice and you get referrals from other practices in the neighborhood. If that revenue stream is not expected to continue into the future, then it is going to be difficult for you to sell that practice at a very high multiple. Because if you have a potential buyer come in who doesn't have your surgery expertise, doesn't have your relationships with the other practices in the area, they're not going to be able to generate that revenue. And if you cannot be fairly certain as a seller that a new owner will be able to generate the same level of revenue that you do, then it's going to be difficult to have a high level of goodwill and a high value for the practice. This is not usually a problem in veterinary practices. Most practices are able to transfer the goodwill fairly well, but you do see it occasionally when a practice does something that's genuinely unique compared to other practices. Regardless of the method that's used for valuing the practices, the key point of this is that revenue is not a predictor of practice value. You simply have to look at practice profitability and some of the other risk factors. What's difficult about understanding practice profitability or determining practice profitability is that it's not an easy number to get. In small businesses, the tax returns and the financial reports that you get do not show what your true profitability is. And that doesn't mean that they weren't prepared properly. Generally, they are prepared properly. It's simply that they weren't designed to show true practice profitability. And there's a couple of different reasons for that, which we'll talk about in a few minutes, but this makes it hard for people to understand the concept of profitability and to actually know what theirs is. And again, it's important to remember that just because you have a high level of cash that you're taking out of your practice, it doesn't mean that you're profitable. I worked once with a practice that had a gross revenue of about $10 million, and the owner was taking $1 million a year out of the practice. And in almost anybody's books, $1 million is a lot of money. However, that practice had a very high level of expenses, and when that practice was valued, it was only worth about $3 million. So the profitability was very low, the profit margin was very low, even though there was a lot of cash coming out of that practice. Another important figure or an important concept to remember is that the number called taxable income on your tax return or the number called net income on your income statement or your profit and loss statement may be dramatically different from real operating profit. I've never seen a practice where true operating profit equaled net income on the income statement or taxable income on the tax return. So there's a separate calculation that has to be done. Dollar profits should represent the amount left over after all the normal and necessary expenses of the practice are paid at fair market value rates. And we'll talk about what that fair market value rate concept means in a few minutes. Profit margin simply is calculated by dividing the dollar profits by the gross revenue of the practice. So you'll end up with some kind of a number between 1% and 20%. I mean, you do see practices with a negative profitability, but most of the time it's between 1 and 20%. And it's that profit margin, that percentage number, that allows you to compare your practice to another. You don't get meaningful results if you compare the dollar profits of your practice to the dollar profits of another practice, because you may be different in size, in number of doctors, gross revenue, whatever other parameters. So you've got to use that profit margin to compare to other practices. So one of the questions that always comes up is, why do we have these differences between the reports that we get in our practice and the true operating profitability? And there's a couple of reasons for that. One is the type of accounting methodology that we use. Large companies are required to use something called generally accepted accounting principles, or GAAP accounting. GAAP accounting is not required for small businesses, for small privately held businesses. And most of the time, small business owners don't have the accounting personnel in order to prepare financial statements on a GAAP basis, and generally aren't willing to pay their accountant for the extra work it takes to do that. So the reports that they get are prepared on a different kind of a basis. Usually it's some kind of an income tax basis. So the profit and loss statement is prepared in a similar fashion to how the tax return is prepared. The tax return is prepared using rules that the IRS has established in all of its infinite wisdom to generate the most tax for the United States. That doesn't necessarily mean that has anything to do with true practice profitability. So a report that's prepared on an income tax basis is not going to show you true operating profitability. And in fact, I have never seen an income statement or a tax return that showed the true profitability for the practice. So those numbers are essentially meaningless if you're trying to look at your true practice profitability. We also have different kinds of entities, legal entities, that small business owners use to practice in. So you may be a sole proprietorship, a partnership, an S corporation, or a C corporation, possibly an LLC. And the tax law drives how the accounting is done on the tax return for each of those different entities. And you can have one business, say, and if you prepared its tax return as if it was a sole proprietorship, you would get a different number for taxable income than if you prepared that as if it was a C corporation. And so simply the fact that you're a different kind of a legal entity makes a difference in that taxable income number. That obviously makes no sense if we're looking at true operating profitability. So in this calculation of practice profits, we have to pierce through those rules that the IRS makes you use to understand what the underlying numbers really are. There's also another factor that I call personal accounting policies. And what this really means is all of the stuff that small business owners run through their practices that really are not business expenses. So this is going to be the trips to Tahiti, the swimming pool payments, the home internet cost, the small animal practice that pays for their daughter's horse feed through the practice, the personal dry cleaning, the liquor store bills, the private airplane. I mean, I could go on and on and on about the stuff that I've seen that small business owners deduct on their tax return. Obviously, that helps reduce taxable income, and I'm not going to go into the legal or the ethical aspects of that, but it also makes the business look less profitable than it really is. So when you're calculating genuine practice profitability, you have to pull out all of that stuff. There's also an influence of debt in determining the calculation of true practice profitability. Interest expense is deductible for tax purposes and for the preparation of an income statement. However, it's not a factor in calculating true practice profitability. So that also has to be pulled out when you're calculating the real profits. What this next slide shows you is the effect of the practice entity type on the calculation of taxable income. So right now we have two businesses, and they're essentially the same, except that one is a sole proprietorship and one is a C corporation. If you notice here, you'll see that the revenue in each of these practices is the same. It's $1 million. The cost of professional services, so drugs and medical supplies, laboratory cost, etc., is $240,000 in each practice. Now, the sole proprietorship has no owner compensation, and that's because the tax law does not allow owners to be paid through the payroll system in a sole proprietorship. The C corporation, however, has owner compensation of $120,000 because the owner takes a paycheck just like every other employee in the practice. The compensation of the professional staff, which is the doctor staff, is the same in each of these practices. It's $130,000, and the support staff costs are the same in each of these practices at $220,000. In a sole proprietorship, if the owner of the practice also owns the real estate, there is no rent paid from the business to the owner as the owner of the real estate. And that's because a sole proprietorship, the owner of the practice, the owner of the real estate are all one and the same person, if you will, quote unquote. In a C corporation, the C corporation is a separate legal entity, and if the owner of the C corporation also owns the real estate outside of the C corporation, there will be rent paid from the legal entity that is the practice to the legal owner of the real estate. Repairs and maintenance in these practices are the same: administrative expenses, depreciation, and all of the other operating expenses. You'll notice that the taxable income for the sole proprietorship is $293,000. The taxable income for the C corporation is $78,000. So even though these businesses are exactly the same in how they operate, the way that they're required to prepare their tax returns gives them a very different taxable income number. So the profit margin for the sole proprietorship is 29.3%. The profit margin, quote unquote, for the C corporation is 7.8%. These businesses are exactly the same, but their tax returns are required to be prepared in different ways, and so it looks as if their profits are different, but they really aren't. This example here shows you the effect of practice entity type on taxable income, or on what you may be thinking is your practice profitability. These two businesses, or this is actually one business, but we're showing what the taxable income would be like if you prepared it as if it was a sole proprietorship, and what the taxable income would be like if you prepared the tax return as a C corporation. And then you can use the rest of the information from previously.